Most people look at their paycheck and feel confused. The number they negotiated for is not the number that arrived. This happens to nearly every working American. And almost nobody talks about why. You make $60,000, and after taxes, you're holding $45,000. You make $100,000. And the gap widens in a way that doesn't make intuitive sense. The math feels broken, but it's not random. It's a system, and like most systems, once you see how it actually works, the confusion turns into clarity. The federal government collected nearly $49 trillion in revenue in 2024. You make $100,000, and the gap widens in a way that doesn't make intuitive sense. That's not millions. Payroll taxes, which fund Social Security and Medicare, bring in another 35%. That's $17 trillion. And it works differently than income tax, which I'll explain in a moment. Corporate taxes contribute 11%, and miscellaneous sources like excise taxes and tariffs make up the remaining 5%. This is the part people overlook. Most of the federal budget comes from working people, not corporations. This matters because it shapes how the entire system is designed. Now here's the twist about payroll taxes. They're separate from income tax, and they operate on a completely different set of rules. When you work, you pay 62% of your wages into Social Security, but only up to a certain income threshold. In 2024, that threshold was $168,600. Earn more than that, and you stop paying Social Security tax on the extra dollars. Your employer pays an equal 62% on your behalf. Medicare is different. You pay 145% with no income cap, meaning high earners pay it on every dollar they make. Employers match that too. 62% plus 145% equals 765% base payroll tax per year. Results vary by state and filing status. If you earn over $200,000 as a single filer, there's an additional 0.9% Medicare surtax that applies to income above that threshold. High earners hit this quietly without realizing it. This is where it gets expensive for the self-employed. Your first chunk of income is taxed at 12%. Now reset what you think about tax brackets, because this is where most people get it completely wrong. Then the next step up is 24%, and so on. You only pay the higher rate on the income that actually falls into that bracket. If you're single and make $60,000, you're not in one bracket, you're in multiple brackets simultaneously. The bottom $15,000 is taxed at 10%. Then the income above that threshold gets taxed at 22%. The jump to the next bracket doesn't mean everything gets taxed higher. This matters because people often turn down raises or side income out of genuine fear of losing money to taxes. The math doesn't actually work that way. You always benefit from earning more, even if more gets taxed at a higher rate. Here's the standard deduction, and this is where things get interesting for your actual take-home pay. For 2024, the standard deduction for a single person is $13,900. This matters because people often turn down raises or side income out of genuine fear of losing money to taxes. This means the first chunk of your income isn't taxed at all. If you make $50,000 as a single person, only about $36,000 is actually subject to federal income tax. The rest, the first $13,900, gets a free pass. This deduction has gone up every year for the past decade or so, which means your actual tax liability is often lower than people think. Most people just take the standard deduction and move on. But some people itemize instead, which means listing out specific expenses that the tax code allows you to deduct. Mortgage interest, charitable donations, state and local taxes up to a certain cap. These can add up to more than the standard deduction. If they do, itemizing saves money. Most people, though, roughly 87% of filers, take the standard deduction because it's simpler and often better. Now here's where it gets real. And this is the part nobody notices until it happens to them. Tax credits are different from deductions, and the difference changes how much money actually ends up in your pocket. A deduction reduces your taxable income. A credit reduces your actual tax bill. This matters enormously, enormously, enormously. If you have a tax credit of $2,000, that's $2,000 off what you owe, not $2,000 off your income, off your actual taxes. Deduction of $2,000 times 22% bracket equals $440 savings, versus tax credit of $2,000 equals $2,000 savings. The credit is worth nearly 5 times more in this scenario. The child tax credit gives you $2,000 per child under age 17. The Earned Income Tax Credit, the EITC, can give families making under $55,000 significant credits that sometimes result in refunds. These refundable credits mean you can get money back from the government even if you owe zero tax. Some people with lower to moderate incomes end up with refunds of $5,000 to $13,000 because of these credits alone. Most people working at regular jobs never realize they qualified for these. They file their taxes, get a small refund, and move on. But the system is designed so that if you qualify, you get that money. That's not a loophole. That's how it's supposed to work. Here's the part that explains why high-income earners often feel like they're paying a disproportionate amount. The top 3% of income earners in America pay about half of all federal income taxes. The top 1% pays about a third of all income taxes. This isn't because they're being punished. It's because the system is progressive, meaning the rate goes up as you earn more. Someone making $200,000 might pay an effective rate of around 30 to 35% when you add everything together. Someone making $50,000 might pay an effective rate of around 8 to 12%. The gap compounds over time. If you earn $100,000, federal income taxes might take roughly $12,000 to $14,000 of that. Add payroll taxes of $9,100, and you're looking at about $21,000 in taxes before state, local, and property taxes. That leaves roughly $79,000, which explains why people making solid six-figure incomes still feel the squeeze. Now, most people miss this next piece, and it's important. Your effective tax rate is almost always lower than your marginal rate. Your marginal rate is the rate on your last dollar earned. That's your tax bracket. Your effective rate is your total taxes divided by your total income. These are not the same number, and the gap between them matters for planning and understanding what your taxes actually are. Someone in the 24% bracket doesn't pay 24% on everything. They pay an average rate that's lower when you account for the standard deduction in the staircase structure. This is the moment where a lot of people feel relief when they do the actual math. Someone making $200,000 in wages pays 37% federal tax. That same person earning $200,000 in long-term capital gains pays only 20%. This compounds over a decade. The more wealth someone builds through investments, the lower their effective tax rate becomes. Most people working for wages don't realize this until they start investing seriously. Here's where it gets deeper. The overall structure reveals something about who the tax system actually benefits. Now let's look at who pays how much. Because the distribution is not what most people assume. The majority of tax filers fall into the 12% bracket. That's over 53 million individual returns. Most people working for wages don't realize this until they start investing seriously. But here's the part that shifts everything. The top 3% of earners pay approximately 50% of all federal income taxes. This single fact gets quoted often, but rarely is the mechanism explained. It's not because tax rates are high at the top. It's because income is concentrated there. Someone earning $500,000 pays more tax than someone earning $50,000. Not just by rate, but by the absolute dollar amount. The higher you go up the income ladder, the fewer people there are. But their income is so much larger that they collectively pay half of everything. This is the part people overlook when they evaluate tax fairness. The system is progressive, meaning it takes a higher percentage from higher earners. But because income itself is concentrated, the top earners still pay a disproportionate share. Most people miss this distinction because nobody explains it clearly. Reset your thinking here. Tax policy is a balancing act between different groups, and the mechanics matter more than the political arguments. Now let's talk about how the tax system has actually evolved over the past few decades. Before 1986, the United States had 14 separate income tax brackets with a top rate of 50%. Most people miss this distinction because nobody explains it clearly. Then came a major reform that cut the number of brackets down to 2, with rates of 15 and 28%. This wasn't random policy. It was designed to simplify the code while still maintaining progressivity. Over the following decades, the number of brackets grew again, and the top rate fluctuated. In 2017, there was another significant change. The corporate tax rate dropped from 35% to 21%, a permanent change that was designed to improve business competitiveness. Individual income tax rates were also adjusted under that same legislation, with lower rates across the brackets. But here's the part that changes everything. Those individual income tax cuts were designed to expire at the end of 2025 unless Congress votes to extend them. The system has layer upon layer, and each layer is designed to be invisible until you interact with it directly. Here's what changes everything. Understanding that this tax system exists. It's complicated, but it's not random. It's designed with incentives built in. The government wants certain behaviors and discourages others through the tax code. They want you to save for retirement, so they let you deduct 401k contributions. They want you to own a home, so they let you deduct mortgage interest. They want you to have children, so they give you credits. They want you to donate to charity, so they let you deduct those donations. Once you see the system as a set of incentives rather than punishment, the whole thing becomes less stressful and more strategic. That doesn't mean you can ignore taxes or find loopholes. The IRS has teams of people making sure you don't, but it does mean you can understand the intention behind the rules and make decisions that align with them. If you're in a situation where you have choices, whether to take a job with a W-2, start a business, invest, buy property, understanding how the tax system treats each of those scenarios helps you make better decisions for your actual situation. Results vary based on individual circumstances, but the pattern is consistent. The more you understand the system, the less power it has over you. The relief comes when you stop feeling like taxes are random and start seeing them as a predictable part of your financial picture. You can plan around them. You can make choices that minimize them legally. You can stop being surprised when your paycheck is smaller than you expected because you'll have done the math first. 3 things to remember. First, payroll taxes hit harder and earlier than income taxes for most workers. Second, your marginal rate is not your effective rate. The actual percentage you pay is lower once you do the full math. Third, the system is built with incentives, and knowing those incentives means you can make better financial decisions for your own situation. If you found this explanation helpful, understanding the systems that affect your money makes everything feel more manageable. Most people never stop to do this math, which is exactly why they feel broke despite making decent money. In 2017, it dropped to 21%, where it remains today. This single change saved corporations hundreds of billions of dollars annually. Smaller businesses weren't really affected, since most operate as pass-through entities where income flows to owners' personal tax returns. But large multinational corporations saw immediate and substantial tax relief. The system was restructured to make the United States more competitive with other developed nations, many of which had lower corporate rates. Here's where it gets real. Corporate tax changes have longer-term effects on government revenue and business investment. But most people don't see this connection. Most people miss this quietly because it doesn't show up directly in their paycheck. But corporate tax rates do affect government spending and, indirectly, the services and infrastructure you use. This is the part nobody notices until the effects compound over years. Reset here. Because the mechanism behind corporate tax is different from individual tax. Corporations file separate returns, pay on their profits, and can carry losses forward or backward. The system is designed to encourage business investment and research. Deductions for business expenses, depreciation, and R&D costs reduce corporate taxable income before the tax rate is applied. A small manufacturer earning $2 million in profit but investing heavily in equipment can deduct the depreciation, reducing their taxable income and federal tax bill. A software company earning $2 million in profit but spending heavily on R&D can deduct those R&D costs, having a similar tax effect. A real estate company earning $2 million in rental income can deduct mortgage interest, maintenance, property taxes, and depreciation, potentially eliminating its taxable income entirely. Corporate profit deductible business expenses, depreciation = taxable income. Taxable income text 21% = federal corporate tax. Results vary by business type and structure. This is the mechanism most people overlook. Corporate taxation rewards reinvestment and operational spending. The company that reinvests its profit pays less tax than the company that takes everything as profit. This is intentional policy design. Now here's where it gets deeper. This system interacts with state and local taxation, which adds another layer. Most states impose their own income tax on top of federal tax, ranging from 0 to 133%, depending on which state you live in. A few states have no income tax at all. Florida, Texas, Nevada, South Dakota, Tennessee, Washington, and Wyoming. These states compensate with higher sales taxes or property taxes. A handful of states have no sales tax either, but they make up for it with income tax and other revenue sources. Most people don't realize how much their state matters for their true tax burden. Someone earning $100,000 in California pays roughly 93% state income tax on top of federal tax. The same person in Texas pays 0 state income tax. Over a 30-year career, that difference compounds into hundreds of thousands of dollars. This is the part people overlook when evaluating job offers or retirement location. The federal tax is only part of the story. State and local taxes added another $24 trillion to the total tax burden in 2022, collected by states and cities. Property taxes, sales taxes, and income taxes all vary by location. Most people don't calculate their total tax burden by location, which is why they're sometimes surprised at how much they actually pay. Here's where the system gets expensive. You can reduce federal taxes through planning, but state and local taxes are harder to optimize without moving. Most people miss this opportunity to optimize their location before accepting a major job change. Pay attention to this because it changes the true value of a job offer. Now let's talk about what taxes actually pay for, because understanding this helps you see why the system is structured the way it is. Federal tax revenue funds Social Security, Medicare, defense, infrastructure, education grants, and hundreds of other programs. About 21% goes to defense and security. Most people miss this opportunity to optimize their location before accepting a major job change. About 17% goes to Medicare. Another 15% goes to Medicaid. The remaining 26% funds everything else: roads, airports, scientific research, national parks, federal courts, the IRS, and dozens of agencies. This is the part people overlook when they complain about taxes being wasted. Most of the money goes to three things: national defense, Social Security, and Medicare. The rest is distributed across thousands of programs. Understanding this structure helps you see why tax policy changes are controversial. Cutting one program means either cutting spending on something else or raising taxes. There's no magic solution. This is the mechanism that drives most tax debate. Reset your thinking here, because taxes aren't just about how much you pay. They're about how government funds operate.